SPY versus QQQ. I think many investors probably mistakenly think this is a value versus growth situation, but that couldn't be farther from the truth. If you're an investor in either SPY or QQQ, you're going to want to watch this presentation because it's going to teach you something about both these assets that I'll bet you don't already know. So they don't need any introduction. These are two of the largest ETFs in the world, certainly the two most liquid. You see SPY at the top there with $535 billion in AUM and QQQ with $269 billion. To understand any ETF, we need to look at the underlying indices. So SPY is actually the first U.S. listed ETF created in 1993, and now it's the largest and most liquid ETF in the world. It's based on the S&P 500 index. We're going to talk about what that is. It's not necessarily the largest 500 companies in the United States. The other ETF we're going to talk about is the Invesco QQQ ETF, most commonly known as QQQ, that trades the NASDAQ 100 index. So just a point on that, you'll note the expense ratio here of 20 basis points. So for all practical purposes, most investors will choose QQQM, which has 5 basis points lower fees. And for all practical purposes in this presentation, we're going to consider these two ETFs to be synonymous. So we recently did a video on the best ETF, and this proposed that one take a holistic look at global equities. We had a fair number of people mention that multinationals in the U.S. could act as a substitute for foreign equities, and that's not necessarily true. So things that you need to consider when you're investing in a index such as the S&P 500 or the NASDAQ 100, you're taking big bets on large caps for one, U.S. currency risk, regulatory risk, tax risk, country risk. All of these are risks associated with a single country. People will say, well, you'll get these same risks in other countries. Exactly. So you're diversifying these risks away. The idea is that you want to minimize risk as much as possible because you don't know future outcomes. And of course, people have a tendency to look backwards in time and back test different ETFs to see how they performed. And of course, we're going to do that. So when we look at SPY versus QQQ performance, we take all the data that's freely available from SRL Global. We do a back test for 39 years, and it shows that QQQ outperforms SPY. So if you invested $10,000 in QQQ, you'd have $46,000 versus SPY at $34,000. But the other thing to consider here is the income that you would have from that investment. So for QQQ, it would be less at $278 a month. And for SPY, it would be more at $452 a month. That's because more companies in SPY pay dividends than those in QQQ. Now, what's interesting is if you reinvested dividends, so you invested the same $10,000, except over time you reinvested dividends, for QQQ you'd have $54,000, and for SPY you'd have $53,000. And at the end of that time, QQQ would be giving you $324 a month in passive income, while SPY would be giving you $694. So a noticeable difference there. Now, before we get into really digging into these ETFs, I wanted to give a shout out to all the degens out there. So degen or degenerates is a derogatory term used in the crypto community to describe people who engage in high-risk speculative trading. And I think that term can go across all asset classes. And it's funny, on Reddit, there's almost an element of pride and one-upsmanship that goes into telling degen stories. And that's because we've all done degen things in our lives. And this slide here is from Long or Short Capital. And they had put out quite a funny piece. This is one of my favorite financial blogs back in the day. I don't know where they went, but they're pretty much describing degen behavior here. So you choose to live paycheck to paycheck, even though you have a six-figure salary. You have a 1% money market savings account with a few $1,000s. Meanwhile, you overdraft your checking account on a regular basis. So it's just being financially irresponsible. what you need to do is manage risk and take some responsibility over your future. That's what we do here at Nanalyze. We help people become better investors. So when you go to leave a comment after you watch this video, please click the link at the top of the comment section and sign up to our newsletter. We're going to help you become better investors. So we get back to looking at SPY versus QQQ. Concentration of the top 10 assets, and you can read this. So you see the names, and we've highlighted names that are similar. So there's certainly some similarities here, but you can see SPY is more concentrated. Their top 10 holdings are 47% of the ETF versus QQQ's top 10 are 32%. And I've simply summed at the bottom the 38% for SPY. That's the total weighting of the stocks in common versus 28% for QQQ. So right away, when we're looking at these names, we're seeing some heavy tech. So when we look at sector weightings for SPY and QQQ, some people probably think to themselves, well, NASDAQ's just a collection of tech stocks. Well, no, it isn't, though it is around half tech stocks, and that percentage is dropping. But SPY is still pretty heavy on the tech, 30%. So it's important to understand what these two vehicles actually are, SPY versus QQQ. So one is 500 of the biggest stocks in the USA. That's SPY, or the S&P 500. Do note that I think few people realize S&P's index committee chooses those 500 securities. So it's not necessarily the 500 largest by market cap. That can lead to omitting some single names. Then you have NASDAQ. And this is interesting because it's just one of two large exchanges in the U.S., and the NASDAQ 100 is the top largest stocks in that exchange. And I think this slide here does a good job of showing you the two major exchanges in the United States and how they're, 45% of the world's total equity, so $89.5 trillion in global equities. And all they've done for the NASDAQ 100 is just chosen this particular exchange and picked 100 stocks. And if you think about the stock market and companies looking to list, they need to choose between the New York Stock Exchange and NASDAQ. And generally, it's considered that New York Stock Exchange has more venerable firms. There's certainly a stronger vetting criteria there. It's cheaper to list on the NASDAQ for smaller companies, for any company, I suppose. And NASDAQ has historically had a reputation of being where the tech firms go to trade. But this diagram then shows you how the S&P 500 pulls from both the New York Stock Exchange and from NASDAQ. Well, the NASDAQ composite, that's the 3,700 stocks on NASDAQ, is, of course, what they refer to as NASDAQ. And the overlap between these two, it's rather interesting. So this is a paper put out by ARK Invest, and it's titled "To Capture Disruptive Innovation, Investors May Want to Look Beyond the NASDAQ 100 and S&P 500. Okay, we know where this is going, but it's actually a pretty good paper. And they talk about the overlap between SPY and QQQ. So since 2002, roughly 22 years ago, the number of holdings common to both those ETFs has increased significantly. So the weight of shared holdings in the S&P 500 and NASDAQ has more than tripled over that time, from 13% to 45%. So both hold 84 names in common. Those 84 names represent 94% of the NASDAQ 100 cumulative weight. Wow, that's interesting. So essentially, the NASDAQ 100 is now a concentrated S&P bet. It's not a differentiated exposure to innovation. Okay, they're going back to that part where they're going to try to sell you their ETFs, of course, but this is a great point for any asset manager who thinks that, oh, if I hold 50% in SPY and 50% in QQQ, I'm diversified. No, you need to plug those into a tool of the type like MSCI makes, and it'll break down all the assets you're holding and look at the constituents of the ETFs you're holding and tell you, look, you actually have a lot more overlap and concentration than you believe that you actually have. And Art goes on to say, today the NASDAQ 100 includes many mature companies that, while considered trailblazers 10 to 40 years ago, are not at the forefront of innovation today. And they say this is quite correct. In their view, technology is permeating every sector, blurring the lines between and among sectors. This goes back to the conversation around there being no AI sector. All right, so sectors are determined. The most common classification, I think, is GICS. That's S&P Global and MSCI. And there's limitations to the way that you classify companies. I think a great example of that would be Uber. They're classified as an industrials company, and everybody would probably say they're a technology company. So going back to the topic of AI, once everyone is an AI, nobody is an AI company. So this definition of technology is changing over time, and you can see here the information technology, the traditional term used, declining over time as a percent of NASDAQ as technology, as ARK said, permeates all the other sectors. The same holds true. Well, for S&P 500, you see it's slowly increasing over time, but then look at ARK and how low their information technology exposure is. And that goes to this chart here, which shows ARK's active share. All this means is the overlap they have with NASDAQ and S&P 500. I say the non-overlap, so I'll bet you the overlap to 3 and 5% is Tesla. But at any rate, they also had this quip on tech stocks and interest rates. I thought it very succinctly pointed to the effect that interest rates have on tech, especially disruptive tech, and their thesis of this opportunity for potentially exponential, if not super exponential growth. Some of that has to do with the interest rates, which surged 24-fold in little more than a year. And these higher interest rates tend to put pressure on long duration assets because you use higher interest rates then to calculate the discount rate that you use to calculate the present value of future cash flows. It's all rather simple if you sit down and do those spreadsheets. In B school, we had to do those on a daily basis. But it really intuitively helps you understand that future cash flows become less valuable with higher interest rates. That's fairly intuitive. Now, in our own investment strategy, we have a barbell of risk. On one side, I think, would be the high quality value, so 30 dividend growth stocks. These are companies that have proven their worth. They come to the table with a great CV. Then on the other side, we really push that risk with high risk growth stocks, 38 of them. Total weightings between these two portfolios are very different. So our value portfolio upwards of 50%. The high-risk growth somewhere around 15%. These are disruptive innovation firms, rarely profitable, capturing market share like mad. In this set, we hope to find gems like NVIDIA, which we were able to spot relatively early on. And this meshes well, of course, with our business, Nanalyze. But as somebody pointed out, there's clearly a FANG gap. Facebook, Amazon, Apple, NVIDIA, Netflix, Google, though we're currently invested in NVIDIA and have been invested in Google previously when they had their IPO. Microsoft, I think, is also very compelling. I believe they have 19 or 22, somewhere in their years of dividend increases. So sooner or later, they'll be coming on our radar for our dividend growth strategy. So just to conclude here, going back to that best ETF video and everybody coming and saying, well, you should just invest in QQQ. Well, the QQQ or bust folks need to recognize there's an element of serendipity associated with the performance of that more or less randomly selected 100 companies from an exchange that companies choose whether or not they want to be on. AI in particular, a very disruptive innovation that stands to benefit many companies, especially those with large proprietary data sets. Now, certain industries may be entering a golden age. What if insurance companies suddenly become massively profitable because they have all this data that can be used to underwrite better policies? Could more entrenched tech companies be threatened? Absolutely. I think the good example of a major disruption is here on the right, the classic chart showing Blockbuster's revenues against Netflix revenues. And AI, generative AI in particular, stands to decimate some businesses. I was just considering that today when looking at how well image generation works compared to the fees we pay for stock photos. So when you're investing, start at the asset class allocation level and know your overlaps. That's the real big takeaway here. So as I said, someone holding equal parts QQQ and SPY is much less diversified than they think. Take inspiration from back tests, but always be looking forward. That's taken actually from ARK. They have a pretty good point they make there. So for those wondering what to do as an alternative for just going pure QQQ, well, you can certainly look at concepts like the 3 ETF portfolio. So I'm going to go ahead and leave this next video with you. It touches on concepts around John Bogle. It's rather interesting. Please make sure to sign up to our newsletter in the comment section. Thanks so much for taking the time to watch this today.